This comes back to that 80-20, right? And so, the capital stack, generally speaking, doesn't look any different than a traditional capital stack in a real estate syndication or real estate fund. Your token holders are generally going to be common equity holders or preferred equity holders. Most typically, it's going to be a preferred equity holder, right? They're going to hold a unit that gives them a preferred rate of return, gives them their capital back, and then gives them, X% of the upside when the project sells.
Jason Powell, welcome to Digital Building.
Thank you, Mandy. I'm happy to be here.
Yes, excited. So let's dive right in. You are an attorney who's been working in the real estate security space for a very long time. So give us some information. Tell us about your background.
Sure. I went to law school a little later in life, and I was one of those few people who knew kind of exactly what I wanted to do when I went to law school, and was fortunate enough to, when I finished law school and came out and started practicing law, that I started immediately doing a lot of real estate capital market work. So I started doing a lot of real estate joint venture work, real estate syndication work, and real estate fund work. I've been doing that consistently for 18 plus years now. And then, come along 2017, 2018, when you started hearing the tokenization conversation, I was really intrigued by that and the potential that existed with respect to doing that. And I started kind of diving right in. And following it as best I could. Since that time, we've seen, the rest of the world really kind of take giant steps and leaps and bounds ahead of where the U.S. is. But I think the U.S. is finally catching up, and I'm excited to kind of be at the ground level, at the forefront of kind of this transformational change I think we're going to see in the real estate capital market space.
Mm-hmm. And you really are in this unique position because you're literally an expert on kind of the way things have been done for the last 15, 20 years or more. I mean, maybe 100, right? But for you personally,
sure,
for that long, and then moving into this new space. So I think there's so much opportunity for you, and it's amazing. But I know that you're talking to a lot of sponsors, real estate owners, and they're still a little skeptical of all of this, and, they have a right to be. So tell us about conversations you're having with people like that.
Yeah, and I think some of the things that I'm hearing a lot of initially on the sponsor side is, our investor base is an older crowd. They're used to doing things the way we've always been doing them. And I don't want to run into the friction where not only do I have to sell them on my next opportunity, but I also have to explain what tokenization is. And so I'm hearing a lot of that. And that's one of the things that actually led me to starting my blog, because I think there's a lack of education in the space. Because at the end of the day, the deal looks the same, the real estate's the same, the operating agreement is the same with an added kind of tokenization transfer layer on top of it. And so, 80% of what always existed before is still there. And then you've got this token layer that is kind of the added 20% on top of it. So, that's one of the things I'm hearing a lot of. And then I think I hear a lot of, I had a lot of conversations surrounding, what are the added risk factors of, having my ownership interest on the blockchain, and, how can that be compromised? Can it be compromised? What happens if it is compromised? What kind of safeguards can we build in to make sure that if it is compromised, we can make sure to take care of our investors. So those are probably the couple main conversation points I'm having with a lot of issuers and sponsors.
Mm-hmm. Yeah. And so since this is a situation where it's like 80% is, the same, and that 20% isn't, I guess my question is, how will clarity, if it passes, help with this? Sorry, it wasn't in the questions, but it just occurred to me.
Yeah.
Do you think it will?
I mean, I think it will, from the standpoint that I think there are people out there who know there's not, in terms of there's not a lot of regulation surrounding it, other than, they've come out and said the token is an actual security per the Howey test. And so I think just the federal government taking the step of, implementing regulations surrounding the blockchain and then kind of the entire space will, for lack of a better term, will help create some clarity
and
some kind of calmness in the market that I think will help move this forward in a little bit better and more formal fashion than kind of it's been thus far.
Yeah, that's true. And I like to share with people that we don't need clarity to pass in order for us to tokenize real estate. Like, it already has been established that this token is a security, and thus we can move forward with it, which makes me really excited. But I also think, and for the audience who isn't aware, what I'm talking about when I say clarity is that there actually is a very large piece of legislation called the Market Infrastructure Act, and it's called Clarity, that gives us the ability to understand what each token represents and move forward in the space fully with that understanding. So that's what we're talking about when I say clarity. But so back to the question. So what's the most common misconception you see real estate owners or sponsors walk in the door with when they first are exploring tokenization?
Well, I still hear, unfortunately, I still hear a lot of conversations surrounding, and I think there's kind of 3 or 4 big ones. I still hear a lot of conversations around, the token's not a security. It's pretty easy to kind of dispel that one, given the SEC guidance we got a little earlier that, your token, if it represents an ownership interest in an LLC or a limited partnership, is an actual token. The other big ones are, it will let me raise capital faster. I think that's a little bit of a misnomer as well for folks thinking that it will do that. I do think that tokenizing assets will increase kind of the investor base. And I say that because I think traditionally investing in real estate syndications and funds has been, accredited investors who are kind of up there in years and who've seen a lot and done a lot.
Yeah.
And they're investing. Whereas if you start tokenizing things, I think you're going to start appealing to a younger crowd. And I also think, given that the rest of the world is so far ahead of the U.S. when it comes to tokenization, foreign investors really understand this space. And so I think when you tokenize projects, you're able to invite more foreign capital into your investment as an option. And the other big one I think that I hear a lot of is the liquidity. And that liquidity is going to be immediate, and I think that's eventually going to be the case. But I think the liquidity promise is an overpromise at present, and I think we're still a couple years away from where we really have that buyer market and seller market, and we've got the market makers participating. We've got sponsors and issuers who are more readily or more easily in a position to kind of share information to help the buyers and sellers come together on what that value looks like.
Right.
So I think those are kind of the three big misconceptions that I hear a lot of.
Yeah, and I think one thing that I've discovered over my study is I've been saying that tokenization will make real estate more liquid. And what I mean when I say that is that you're often locked in with your equity, and the only way that you can turn that liquid is to sell, right? But the liquidity that we're talking about when we talk about a secondary market is different than that, right? Like, that's a different kind of liquidity that we're talking about. And so I'm doing this for my audience because since I don't have a background in markets, but I have a background in real estate, I just kept thinking, this makes complete sense. Once you tokenize and you get it out to investors and they own a fraction of it, like, now your illiquid investment, meaning the sponsor, is now liquid, right? And so I think that can be confusing. And so there are two different liquidities that we're kind of talking about, same concept, but in a different way. And so we have a lot of newbies who will be listening to this, or people who work in construction or architecture or engineering and maybe don't fully understand the asset side. So I wanted to just point that out. Can you quickly run through like the general, the regulations, the Reg D? I know Reg S is something we talk about, and then Reg A is also something that comes up a lot. Can you just give us a brief explanation of what those are?
Sure, and those are part of the 80% that hasn't changed from kind of traditional syndication and fund stuff, right? And under Reg D, we've got two rules. We've got a rule 506C and a rule 506B. They're slightly different in that 506B is the traditional way in which syndicators used to go out there and raise capital. And 506B basically limits you when you're the issuer. You're only going out and raising capital from people you've got a substantial pre-existing relationship from. 506C came into effect with the Jobs Act. And 506C, a term you'll hear thrown around a lot is crowdfunding. And 506C sits under the umbrella of crowdfunding.
Okay.
And when you do a 506C offering, you're able to market and advertise your offering to the general public. But because you have the right to do that, you have to take additional steps to verify that all the investors coming into your offering are accredited. And that generally means you have the investor submit a letter from the investor's attorney, the investor's CPA, or the investor's stockbroker saying, I've verified that ABC investor is in fact accredited, and then the issuer can rely on that process. Reg A has been around for a while, but Reg A in its current form also was a result kind of the Jobs Act. Reg A is, let's call it a mini IPO. Reg A lets you raise up to under Tier 1, lets you raise up to $75 million from the public, and that accredited investors and non-accredited investors alike. There are some additional steps in that under Reg A. Your offering document has to be submitted to the Securities and Exchange Commission. It has to be signed off on before you can start raising capital, whereas under Reg D, you don't have to have any sort of approvals before you're raising capital. But the nice thing with Reg A Plus is raising money from accredited and non-accredited investors alike. That really opens up your offering to anybody and everybody in the market. And Reg S is the rule that allows issuers in the United States to kind of allow foreign investors into their offering and participate in their offering. That's often done through different vehicles and different mechanisms. And it's used in my practice. It's traditionally been used fairly sparingly in traditional real estate syndication and real estate fund work. But like I mentioned a little earlier, I think that's going to become hugely impactful for people looking to tokenize their project, because those foreign investors have a lot more experience with investing in tokens than investors in the U.S. at present.
Yeah. And can you tell us about if I was someone who wanted to get accredited, what are the requirements for that now in the U.S.?
So generally speaking, for an individual, it means you have a net worth of $1 million, excluding your primary residence, or you've got an income of $200,000 as an individual, or $300,000 with your partner spouse. Those are kind of the general parameters for an individual to qualify in the U.S.
Okay. And I do know that the SEC Chair Paul Atkins has said they intend to revisit those laws and perhaps change it such that people could take a test or something like that would make it easier for people to invest. So I hope that happens.
You and me both, yes. I think adding some sort of, whether it be a test or some sort of other kind of knowledge qualifier to people being able to qualify for an accredited investor would do good things to this marketplace.
Okay, so let's go back to that secondary market, the actual market one.
Sure.
That we're talking about. What do you think needs to happen in order for us to really have a robust secondary market?
Well, that's an interesting question, I think, Mandy, and it's a kind of a tough one to answer. I do think we have to reach the point where there are more tokenized offerings at present. And and more of those tokenized offerings have reached that kind of the end of the 12-month hold period that initial investors have, and then those have to be put on that marketplace, and then you really have to have those alternative trading systems, those platforms that are going to be able to participate in the secondary market. They really have to have the buyers there.
Yeah.
Because that's going to be key, right? I think we're always going to have sellers, right? Because many people get into syndications and funds, and then, life happens, family events happen, they need out. Traditionally, it's not easy to get out, and it's a process, and sponsors have to approve it, and you've got to get a legal opinion and things like that. And so you're always going to have people who want out, but I think those platforms have to do a good job of bringing the buyers to the table.
Yeah.
And then I also think in many respects, you're going to have things either built into the governing documents, or you're going to have sponsors who are willing to share valuation information, whether that be in the form of, the most recent appraisal, financial statements that current investors are getting, or any kind of number of different documents that can allow the buyer and seller to kind of meet in the middle and find that price where I'm willing to sell and you're willing to buy.
Yeah.
These investments are not like traditional, traded securities on the open market, right? Because those are publicly available information is all over the place on those companies, and that you just don't have those requirements with respect to these types of offerings. And so I think you've got to have issues, just have to be willing to kind of do that.
Yeah, absolutely. I recorded a podcast with Jad Ketchmar from Pripco this morning, and he said every 3 months they do a new appraisal for all of their properties. Have. Every 3 months. I thought, oh my gosh, that's a lot of time spent, so just really interesting to think about how, I mean, when this happens in the US, it's going to explode, but I think it feels like, we're a long way off from, even yearly, even annual. So every 3 months is going to be wild, but AI will change a lot of things. So, we'll see. So,
and I think as long as you can keep that, that cost reasonable for an appraisal, right? Because current investors are bearing that cost, right? In the forms of, distributions they're not getting. And so as long as that appraisal cost is, good value in it, and it's not, $5,000 or $10,000 a time, I think that's a great way of doing it.
Yeah, absolutely. And I can see ways that AI and blockchain together can really help that. So, I mean, I think we'll get there. It's a matter of time, and we don't know how much time, but we'll get there. And hopefully we'll be around for the day, right?
Exactly.
Okay, so walk us through what the actual deal structure looks like when you tokenize a commercial property, and where do the tokens sit in the capital stack, and what rights do token holders actually have?
Sure.
Big question.
Yeah, and this comes back to that 80-20, right? And so, the capital stack, generally speaking, doesn't look any different than a traditional capital stack in a real estate syndication or real estate fund. Your token holders are generally going to be common equity holders or preferred equity holders. Most typically, it's going to be a preferred equity holder, right? They're going to hold a unit that gives them a preferred rate of return, gives them their capital back, and then gives them, X% of the upside when the project sells. In terms of voting rights, again, generally speaking, token holders are going to be pretty passive investors. This varies from deal to deal and syndication to syndication, but the vast majority of syndication holders, the token holders, are going to be passive investors and have very little voting rights. And if they do have voting rights, thresholds are probably only going to be majority thresholds, and those majority thresholds and those decisions are going to be, kind of very high level decisions, such as, removal of the manager for the general partner for cause, appointment of a new general partner, pursuing, if it's a fund structure, pursuing assets that are kind of outside of the initial investment mandate that was disclosed initially to investors, maybe exceeding some debt thresholds, certain major things like that. But otherwise, the manager general partner is going to have the day-to-day control over virtually everything. And just like a traditional syndication, token holders, when you own equity, you always sit behind debt, so the debt is going to have, they're going to be in a first lien position against the subject property, and they're going to receive first proceeds upon sale. Certain loan documents may also limit the amount of distributions that can be made and things like that. I do think, now that we're kind of talking about this brings up another interesting point that I think I'm not so sure lenders have figured out how to lend on properties when the ownership interest has been tokenized and those tokens can change hands. I think that's a big area that's going to need a lot of work, and I think hopefully that starts coming out fairly soon from some of the kind of the government players, the Fannie Mae, the Freddie Mac, folks like that, in terms of, how are we going to underwrite these deals? How are we going to, are there going to be any sort of transfer restrictions? Are we going to allow, 50% of the tokens to be traded on an annual basis, or I think there's a lot of work to kind of be done there before tokenization could really hit mainstream in the U.S.
And I do know that within Clarity, there was a section that addressed that after it passed, there would be a committee put together that will basically start doing that work.
Yeah.
Determining those kinds of things. So, as quickly as this administration is moving on some of these things, hopefully it's going to happen sooner than later. So I wonder if it's really too soon to ask you if you've seen any horror stories or seen any of this go wrong at this point. It's just still early.
Well, I mean, I think a couple of the things that I've seen. I mean, being in this space, I'm a big collector of documents and offering documents and PPMs. Just because I'm always looking to improve my own, but I'm also interested to seeing what other people are doing out there. And so I think some of the things I'm seeing initially is you're seeing offering documents where the drafter, the lawyer drafting these, while they may be a securities attorney, they clearly don't understand the smart contract, the blockchain. The documents are either like platform forms, or they're just syndication forms that the attorney has failed to kind of really customize and build in all the necessary tokenization pieces that actually need to and should be built in to these documents. So that's a big one. I think another one that I'm seeing a little bit of, and this is no different than a traditional syndication or fund, but kind of sloppy when you're doing under 506C and you've got to take extra steps to verify that people are accredited, is just that sloppy process of verifying that your investors are in fact accredited. And then I think, well, I haven't necessarily seen this. This is the one that kind of worries me the most, is the kind of the cybersecurity and the key management failures that potentially exist, right? And are these platforms and transfer agents, are they prepared to deal with situations where keys are lost, there's been a breach of wallets and things like that? And while I think some of that stuff needs to be built into the governing documents on a fund syndication, it's all well and good if it's built in there, but you also need these transfer agents and ATSs to kind of be cooperative and to understand, that they're also going to be involved in fixing these issues.
Do you think they do?
I'll be honest, I don't know.
Yeah.
I hope they know.
Yeah.
And I hope they're as concerned about those issues as I am. But I honestly don't know.
Yeah. Well, I think, first of all, your PPM sounds like it's going to be the gold standard at this point. You're the one everyone should be looking after to, make sure that their documents are protecting their clients, for sure. Really interesting. So at the beginning, you said, you have a lot of hope for this, as do I, right? We share that. What is it about this space that makes you so excited?
I love change, and I love what comes with change, in part because it requires, just speaking for myself, it requires me to kind of learn something new and think outside of the box and look at things from different angles. And I kind of love to be challenged in that way. So I think that's what makes it really exciting for me. And then I also think, I think this is a way to kind of update and move the tokenization fund space forward in a meaningful way that will start attracting a younger investor base into these projects. And I think when you do that, that is really exciting, right? And I think that's what the market needs in many respects too.
Yeah. We both have kids in their 20s, and like thinking about, what they want to invest in and whether or not it's even realistic for them to think about buying a home, right. At this point. And we hope they can, but if they can't, they need other opportunities to build wealth.
Right.
And so I think this is absolutely just one of those ways. And I always believe the learning is the ROI, and every single challenge that we have to overcome to make this a reality for the world is it kind of like just makes it sweeter when it actually is,
Right.
I think so. Yeah, well, this has been really interesting. And, we're in the weeds. This is like the real deal, right? We're really saying, here's where we're at. This is the reality of where tokenization of real estate is at in, July of 2026.
Right.
I'm excited to talk again in 3 months and see, where we're at then. And I know we're working on making this a reality for people. So any last words that you have for our audience?
No, I mean, I just think that, real estate obviously is the biggest asset class, kind of around, right? And I think what's coming in the U.S., the rest of the world has already experienced this, but I think it's incredibly exciting time if you're a sponsor, if you're a manager, if you're a general partner, and if you're an investor in the space. And I encourage people to continue educating themselves about this, because really when it comes down to it, like I've said a couple times, is 80% of this looks exactly the same as a traditional project would look. And so spend your time, evaluating that 20%. But when you're evaluating this deal on the investor side, I mean, the deal's the same. It's just the wrapper of the representation of the ownership interest that is slightly different than it was before.
Yeah. And it's built on the internet, which is pretty cool.
Right. Exactly.
Which is kind of what we need at this point. So you heard Jason, audience. If you loved this and feel like you were educated, then please share it with a friend and continue to educate yourself. Listen to all the podcasts we're producing, because we're really honing in on this subject, on AI and on robotics, and how these things are going to change the built environment and commercial real estate. So please like and share. And Jason, thank you again so much for being here today and sharing, getting in the weeds with us. We just really appreciate it.
You bet. And thank you, Mandy. I appreciate all you're doing in this space.
Yeah, thanks. All right. Take care.